Welcome to the latest edition of The Bull, the Bear, and You as we navigate what is happening in the economy and in investing. I'm Stacy Smith, and I urge you to hit the like or the subscribe button on whatever platform you happen to be watching or listening to this program. The market reaction to the Trump tariffs has not been good, so what should you do as an investor during this volatile time? We'll take a look at that and more in this edition of The Bull, the Bear, and You. And with me to talk about the economy and investing is my panel of financial advisors and experts, and they are Carrie Coghill of Coghill Investment Strategies based in Pittsburgh, Frank Rossetti of HF Management Company, Kim Forrest of Boca Capital Partners, and Michael Godwin of Fergasso Advisors. In the last 25 years, the markets have seen three major upheavals. The dot-com bubble burst in, 1999, 2000. The housing and credit swap collapse in the year 2008. And the COVID crisis in 2020. 2008, 2020 were seen by some as catastrophic for the economy when they hit. Well, now we have our fourth major upheaval, the imposition of across-the-board tariffs, which triggered a rout on Wall Street. It remains to be seen how much of an impact the tariffs will have on the economy, either good or bad, but the initial reaction by investors is not good. In just 3 days, the Nasdaq dropped more than 16%, the S&P 500 more than 14.5%, and the Dow Jones Industrial Average by more than 13%. Now, in basic numbers, $6.6 trillion of market value was wiped out just on Thursday and Friday. We'll have to see what happens on Monday and what those numbers look like at that point. So it isn't just the drop, it's the widespread nature of this drop. Big corporations in tech, manufacturing, and retail, they are all seeing declines in their stocks. Now, I think every one of you would agree selling during a panic is not necessarily a good idea. But do you just hold on? If you've already seen a decline of 5 or 10% or maybe even more in your portfolio, do you just write it down? Carrie, we'll start with you.
Well, I mean, there's a lot. There's a lot to consider. And the answer to that is you shouldn't be sitting on your hands. I think that the most important thing we do for our clients during times like this is tax loss harvest. I mean, when you have these declines at this magnitude, it really gives you the opportunity to get in there and tax loss harvest. Now, the interesting thing is you have to be very careful when you do it because you cannot be out of the market for a day. So what we look to do during times like this is really what we call tax swaps. So if we have a stock in one sector that is in a loss position, we will sell that stock and buy another stock in the same sector, same day. And, you know, the volatility, the thing that's really important to know is that the biggest up days in the market come immediately following the biggest down days. So you can't afford to be in cash. The other thing that we've been doing is really looking at the nature of, you know, what does this look like on the other side and where might there be opportunities? So, for example, if you're looking at the small cap sector versus another sector like even international, as we come to the other side of this knowing what we know, which companies are going to be in a better position to recover? So, you know, I don't think it makes sense to sit on your hands, but what it doesn't make sense to do is, this is not advice to people out there, but it is generally not a good idea to go to cash. And I will tell you, everyone wants to sell. I want to sell. But guess what? I don't know when to get back in. Selling is the easy part. We talk about that all the time. You cannot afford to be out of this market if you've already written it down because you lock in your losses.
I think Stacy. Go ahead, Frank.
Go ahead, Mike.
No, after you.
Just to add to that, Mike and I have talked about a correction wouldn't be out of line at least Mike and I talked about it, and now we're having it, and it may turn into a bear market today at the rate it's going, but that remains to be seen. That being said, if you prepared for the recession by getting defensive in one way or another, you now might start to unwind that defensive stuff and go back and incrementally go back to more aggressive positions, which is effectively what Kerry's saying, and that's just adding on to it. If you went to cash, you went to cash. Kerry's right. This is not the time to stay in cash.
Here's the problem I have with this sort of bear market. I think, Stacy, is you can't plan around this. You can't trade around this. Like COVID, this was more or less man-made from an extent of a market standpoint. And what I mean by that, what Trump did on Liberation Day, this is not a political statement one way or the other, but it was far greater than the even most dire predictions out there on the street. Nobody had thought, even Scott Bessent 2 days beforehand, didn't think that would it be, he was the Treasury Secretary, thought that it would be this high of a tariff rate across the board in every single country out there. And so that's what caused the markets to sell off so dramatically over the last 3 or 4 days or so. That could reverse, like Kerry said, on a dime, based on a political whim in Washington, in Beijing, elsewhere. And again, I think this really kind of stems down to U.S. and China, not necessarily all the other EU or Vietnam and Bangladesh and all the other countries that have large tariffs out there. But it could change very, very quickly. So should you do something? How can any of us really say yes or no? Get defensive now, sell stocks now. You don't know. You should have a plan, long-term plan. If you're in retirement, your portfolio should have already reflected a very diversified set of securities and asset classes in there that have held up a lot better than just the S&P 500 over the last week or two. If you are younger, this is probably an okay time to buy. Do I think stocks are cheap? No, I don't. If the course stays the same and we have these tariffs on for a long time, stocks aren't necessarily cheap. They're not necessarily expensive, but it's still a very, very good time to buy because guess what? They are 20% cheaper today than they probably were a week or two ago, assuming your earnings expectations sort of stay the same for companies, which Kim can probably point out. Nothing has been revised lower yet, so stocks aren't necessarily that cheap. But longer term, as Kerry and Frank will also tell you, the markets have never not recovered from a correction or a bear market.
So I have three things to say. First, yes, on the volatility. As we started taping this is Monday, January, I wish, Monday, April 7th, there was some rumor out there that caused everyone's hopes to go up, and the markets went up, like NASDAQ was up 3%.
Yep.
That's the turnaround we're talking about. So good things can happen. That's always my tagline. And you don't know when it's going to happen. So that's why you have to stay in markets as uncomfortable as it feels. My second thing is, and this is, I'm trying to bring some humor to this because I know people, this is the money that's supposed to protect you, put your kids through school, whatever. I understand. But the Babylon Bee had this great headline that said financial advisor calls clients and says, panic, sell everything, buy everything, move into bonds, don't move into bonds. It was awesome. I mean, okay. And the third thing I have to say is I love to know why. I think you should follow the advice of the people that just talked. But I am looking at why did these markets go down so precipitously the last couple of days? 5% sell-offs next to each other are remarkable. What I just heard, again on financial TV, is the big sellers were sovereign funds. And my opinion on any outside investor in a country is this is dumb money. These are people that generally come in late, they buy too late, they sell too early. And we'll see what the volume is today and what happens on all these rumors that are going to probably be crossing the wires. But if that's true, that dumb money sold and has given short sellers an opportunity to close out some shorts, which I'm sure they can, we might see a slight rebound even by the end of today. And these are all market mechanics, not having to do with tariffs, not having to do with what might happen in the future, but these are market mechanics that have driven things down very quickly, very fast, making it scary for an ordinary investor who isn't investing like hedge funds and sovereign wealth funds.
So that I've got all of your comments lead me to two questions. I'm going to follow up on yours first, Kim, and that is, who is selling all of this then? I mean, you just said sovereign funds, but I mean, average investor out there in their 401ks or IRAs, they're not the ones who are driving this market down. So these are huge numbers of decline. So who's doing it?
Right, like, well, I don't know, Wealth Fund of Abu Dhabi, think they have a few nickels to spend, I think. So these are, they were getting out of positions indiscriminately. And by that I mean, generally, whenever you're going to sell a position, you might work it over a couple of days. And if they were big holders of, let's say, NVIDIA, they just probably said, dump it, sell it, get rid of it. I don't want to wake up with it in my portfolio tomorrow, okay? So that is what makes really unruly markets. Generally, if you're based in the U.S., you may not have the luxury to do that because the SEC is going to come knocking on your door saying you moved the price of the stock because you were such a big holder. Bad, manager. So I hope that answers your question. So that is what a sovereign wealth fund is a country that has a bunch of money, billions and billions of dollars that it puts to work in various investing concerns around the world.
All right, now this is a follow-up question to what Frank and Michael and also Carrie had to say, and that is, do you change your, let's say you're on a 401k and you're buying the ETFs, or you have throughout the last several years, and you've done pretty well with that. Do you change that plan at all, or do you just keep on going with what you have been buying?
I would say it's too late to make those changes. If you didn't get defensive more than a week ago, it's probably too late. And I would probably just ride it out. If you're near retirement and you listen to what Carrie has said many times, and we've all agreed with her on that, you should have 3 years worth of cash hanging around to take out, so this doesn't mean anything. And hopefully this recovery will happen in less than 3 years.
Yeah, well, I mean, I would look at it maybe a little bit differently, and it really depends on a person's age and time frame. But yeah, you have to figure out when is the right time to rebalance a portfolio. So if you are contributing to your 401k and you have a certain allocation, looking at how that allocation evolves over time and even evolves through a market decline. So let's say that you wanted to have 20% in large cap growth, and now because of this decline, that 20% is now actually only 15%. Well, it might make sense to consider rebalancing your portfolio so that you increase your position. As Frank was saying earlier, the whole idea here is to buy low and sell high. So really, you have to pick those points, those inflection points, where it makes sense to say now is a good time to rebalance. I will tell you that at the beginning of the year, we rebalanced portfolios because the growth had gotten to be too big, right? So, and people are like, why are you rebalancing? It did so well last year. Exactly. We want to capture some of those gains and put that money into a portion of the portfolio that hasn't done as well. Very counterintuitive emotionally, but when you're employing a sell high, buy low attitude, that's what you have to do.
All right. On the positive side, according to an article I read, I don't know if it was the Journal or Bloomberg, that investors poured more than $60 billion into money market funds in the first few days of April. That set it to a record $7.4 trillion in those funds. So that's a lot of money that can go right back into this market, isn't it?
Wait, it also could go to tax bills.
Well, true.
That is true. I mean, but no matter what, if you look at the chart of money market balances over time, it is a chart that is up and to the right, meaning it continues to get bigger and bigger, regardless of whether you're coming into COVID, out of COVID, into the great financial crisis of 08, out of it. It continues to go up and to the right. So you're 100% right, Stacy. There's a lot of cash still on the sidelines. That's probably a net good thing for the markets. Hopefully we can sort of rebalance in there. But I by no means do I think that that will deplete and all go into the stock market. Again, people have a short-term memory when it comes to interest rates and whatnot. They see that they lived through 3 or 4 years of zero interest rates, even though rates have come down a little bit over the past 3-4 months. They're still higher than 0%. So a lot of investors love clipping a risk-free coupon of, what are you getting on a money market now, 4.25 or something like that, probably 4.5 maybe. So people are okay to sit there and they're content waiting. I don't think that's all going to come back into the markets, but nevertheless, net is going to be a positive, because some of that probably will at some point.
All right, I think it was you, Michael, who mentioned this, but I'm not sure, that the tariffs, it seems, it's China and Vietnam and a lot of the Asian countries here, and everything centered on these. Will the first quarter earnings carry as much weight right now? They're starting to come out, what, Kim, next week or so?
Yep.
Will they carry as much weight in your analysis down the road because of what's happening right now with tariffs?
You want me to take that, Kim, or you?
Oh, I thought he was talking to you, but.
No,
I
I was
I'll
talking
start.
to you, Kim. No, go ahead,
Oh,
Michael.
okay. I always look at the pipeline, the forward projection. To me, like what they did in the prior quarter, it's interesting, but I am really focused on forward earnings, what they're seeing in the pipeline.
Right,
and that
but
is going to be the most important thing.
But how? What I guess my question is, and I understand that, but with what's going on, are they ready to make that analysis as to how they're going to be when nobody really knows what in the world's going to happen with these tariffs?
Well, yeah, I mean, they're going to know who dropped out of the pipeline. Like, they have to tell you that. And they're going to couch it in all kind of, they being the companies that we listen to.
Right.
So the companies are going to say, look, we live in uncertain times. Uncertain will be like, do not have that on your bingo card, and certainly don't play drinking earnings call listening, because you will be smashed in the first 5 minutes. Honestly, uncertainty. Okay, we know that that's going to happen. But companies use these great things called customer relationship management software, and they know what is disappearing from their their sales flow. So they're going to have to, by law, tell you. But again, they're going to set really low bars. So everybody that is professionally, or if you've just done this for years and years, you take everything with a grain of salt. But you get the direction and magnitude of the sales that have happened in this last bit since the close of the quarter, because they're telling you live data, not what the sales forward-looking number was on March 31st.
What I find fascinating, so just my background is in market history. And you go back and you can look at correlations in time, the internet bubble, take that back to the railroad bubble in the early 1900s. You can look at the financial crisis and look at the financial crisis in 1907. You can look at COVID and look at the Spanish flu epidemic in 1918. Like, there are correlations here. And what I find so incredibly fascinating about this time, people want to say, oh, we've never been down this road. This has never happened before. Okay, it's the reason has never happened before. But the fact that this is happening when it happened, which is the same time frame as when COVID happened, right? And it's going to be the same playbook. For these companies that are reporting, go back and listen to their calls in April of 2020. You're going to get a lot of similarities. And guess what? The issue is the same. It's supply chains. Everyone was worried about supply chains. And that's what this is really all about. So I do think that we have some kind of a roadmap in terms of how companies figure this out. And, in that case, I don't know if we mentioned this or not, there's so much information that, during COVID, the market went down 33% in a month from February to March, almost 33%. And it had fully recovered by August. So you have to be a little bit careful, kind of back to the point of what do? You have to be careful about what you do. And I think the biggest thing we're going to be watching with earnings is really kind of trying to correlate. They say that the market doesn't necessarily repeat itself, but it does rhyme. And if we can kind of look at the dynamics of how these companies worked through the uncertainty of supply chains back in 2020, we may have a little bit more insight as to how they'll do this time around.
And I agree more than 100% with what Carrie was just saying. Like, if that's possible. I'm a math girl, I know it's not possible, but you get what I'm saying. Okay, so I do have to caution you, 2024 was brought to you by AI and overly hyped expectations of what it was. So I'm not sure the S&P will go back to that ending, 1231 value or whatever was that high. But I know that ordinary business is not looking as sad as what the markets are reflecting now. But I do think AI has, the bloom was off the rose already before all of this started. So just keep that in mind.
And I agree with 80% of what Carrie said. I'm kidding. The only thing I would say is, when you talk about COVID, the catalyst that sent stock market higher was Fed cutting rates and free money. That catalyst is not going to be around this time at all. So they may cut. They will cut. They're not going to cut to zero. They may cut. I think maybe 2 times the market's pricing in 4. The catalyst to send it back up is some sort of trade policy. You figuring this whole tariff thing out. And again, you cannot bank on that as an investor. You cannot time that as an investor. You cannot do anything about that as an investor, which is why, as cliched as it is, stay diversified, sit tight, stay the course, yada yada, rebalance. I agree with Carrie 100%. You should be tax loss harvesting now. You should be rebalancing back into stocks that are a lot cheaper today than they were maybe a couple weeks ago or so. But it's too hard to predict on any of those iteratives that have caused this market to sell off so much.
Well, even just what happened this morning. I mean, the rumor was that a 90-day pause on all tariffs except China, and the market went, berserk on the upside. And then the White House reported that was fake news. So, you can't plan your future around that kind of activity, but it gives you an insight as to, if we do get some real news, gives you some insight on how quickly things can turn.
And they've turned again, Carrie, because I keep my TV on and I see the, graphics. I don't know what the rumor is. So this should be, everybody, buckle up. It's turbulence time. I hate flying. And I keep my seatbelt buckled at all times, and you should too. Your metaphorical stock market seatbelt.
Well, you guys are all hitting some very good points here, and especially about the swings in this market, especially today. We've seen drops of 200 and 300 points in the S&P 500, and in the last, since we have been on, I think it twice has gone up. It has gained back more than 100 points, then lost more than 100 points, gained back more than 100 points. So it is extremely volatile right now, and I would not want to be a trader out there. I do want to ask this, and maybe Frank, you can try to tackle this one, and that is, and we kind of just touched on it right here. What do you expect the Fed to do at this point? Do you think they're going to sit on their hands? Will we start to see interest rate cuts? And if indeed the economists are correct that these tariffs are a tax and they're going to be passed on to the American consumer, then inflation is going to go up. So can the Fed afford to lower interest rates?
Well, the Fed has 2 mandates: maintain full employment and keep inflation down. In this environment, those are conflicting, it seems. That being said, they may just sit on their hands. However, if the economy starts tanking, we start seeing unemployment, which last week the report was good. So if that persists, they can fight inflation, which means rates will not come down. All right. If that doesn't persist, which the people who think tariffs are going to put us into a recession, and they could be right, if we head towards recession, we start seeing unemployment, the Fed's going to have a difficult time, which is where that stagflation word comes in. If we move into stagflation, it becomes a very difficult time for the Fed, all right, because their conflicting goals really start conflicting at that point. So they're going to have to make a decision of what's more important. And my bet is the economy will be more important than inflation, and they will start dropping interest rates. But we have to see the economy weaken as a result, and they are data driven. They're not anticipatory, this Fed. And that being said, we'll have to wait and see.
Although
You know,
the
I
Fed
think
chair
that-
did say that he anticipates higher inflation because of this.
Yeah.
Well, yeah, that's reality, but higher inflation for the government is a smaller problem. We have this $30 trillion budget deficit, or national debt, or whatever the number is. And that being said, if we have inflation, that $30 trillion becomes a smaller problem. All right, so inflation for the federal government is probably a good thing relative to national debt.
So a couple things,
there's so
Frank makes a
many
really good
gears
point
in this
because, you know,
machine.
when you look at inflation and you look at unemployment rather, you know, we've not had a recession when we've had pretty strong employment numbers. So, you know, then people start talking about a depression. It's a completely different landscape for that. So keeping an eye on the employment reports is very important. The other thing that I'll say when it comes to inflation is that we can't look at this in a vacuum. We've seen the price of oil come down. We've seen interest rates come down. Yeah, I get that the Fed set short-term interest rates, but we have seen a rally in this bond market over the last week like we haven't seen in a while. So, you know, it's not all bad news. So yes, you might pay more for a car, but the interest rate that you're paying to finance that has gone down, and the oil, the gas that you buy to fuel it has gone down. So, you know, there are some other things here that factor into what impact this will actually have on consumers.
I have to ask this question, getting back to stocks. If the tariffs hold and we don't see changes, are buying international stocks necessarily a great idea at this point? Not necessarily a sector, but just international stocks.
I don't really think so. I mean,
Yeah.
the international community is very, very dependent on exports and sending goods to other countries. U.S. is one of the bigger, importers of goods across the globe. I mean, from a GDP standpoint, we're more than a quarter, I think, of exports for the most part. There's the old adage, when the U.S. sneezes, the rest of the world catches a cold. So I would say it's looking. If they stay in place, I don't think it's a really good investment environment for many countries out there.
I mean, logically, it doesn't seem like it would be because there aren't that many countries that buy as much as the United States does. And so
Correct.
who are they going to sell it to? China
gonna
needs to
take
get
a
rid of its
different-
own product.
I'm going to take a little bit of a different approach on that because when you look at, you look at international investing, and it really hasn't added value in the last 20, 30 years, to be honest with you. You'd be much better off being invested in the U.S. Where international made sense was before globalization because it didn't correlate, right? So you could have times where international performed and the U.S. didn't. I think that we're entering a time where these markets are decoupling. Finally, like we've talked about it for a long time, but even in light of tariffs being on or being off, these countries are going to have to figure out a path forward for themselves. And when you look at the valuation of certain companies overseas, they're much lower than here in the US. So we wouldn't take it entirely off the table. I actually think that going forward, having some portion of your portfolio in an international may serve as a really important piece of creating risk-adjusted returns that are a lot smoother than how international has not supported that in the past. So it's something to keep an eye on.
Okay, we're about out of time. I wanted to say this as the last question. We have seen the markets rebound at this moment. As I take a look at it, the S&P 500's up 23, the Nasdaq's up 150 or so. The Dow is still on the negative side by 150. So, if are we in a bear market, and is this maybe what we're witnessing right now? Well, I absolutely love this phrase from Wall Street. Are we in a dead cat bounce area right now?
I'm going to just charge right in here, and I don't think we are in a bear market. Bear markets are there because of true structural issues like high inflation and high unemployment and a sad economy. We really don't know the direction of the economy for the next 6 months. Let's just straight up and say it. But the last month or the last quarter was surprisingly strong in hard data. There was a lot of sourness coming in from the soft data, and by that I mean consumer sentiment, purchasing manager sentiment. Feelings were bad, but the actual economy was still robust. And I think we can slide on into this next quarter with that at our back. But I think we're in crazy market, like googly eye market. Like you just shake it and it's random, right? So I don't know what's going to happen here, but I don't think it's a bear market, like a true bear market.
Bear markets don't happen in 3 days. They happen over time. And so if over time we get a dead cat bounce, as you say, and then it continues to go down, we might be able to call it a bear market sometime in the future. But I wouldn't call these 3 days a bear market. That's just a panic. And if it continues, who knows? And it's a hot mess, as Kim likes to say.
Yeah. Michael, Carey, you agree?
Bear market to me, it doesn't really matter the definition, right? Because the definition's down 20%. But
Right.
What's more important is what does the economic landscape look like? And I think investors, as Kim said, put your seatbelts on. It is going to be volatile, but just remember, if you, looking over the last 25 years, if you look at the growth of an investment, if you're out of the market the 10 best days, 10 out of 25 years, you more than cut your return in half. So the thing is to own good quality, to make sure that you understand your risk tolerance. And let's remember what we're trying to do here. We have people calling that are, 40 years old and don't need this money for 20 years. So, let's have some perspective. Make sure the cash flows are there. Make sure we're taking advantage of tax loss harvesting. And we're probably going to have some volatility. During COVID, it was like 6 months. So, and we got through it.
Okay. Michael, thank you. Carey, thank you. Frank, thank you. And Kim, thank you. We'll continue our look at the investing and the economy in future editions. And since you are watching or listening to this program right now, I ask that you hit the like or the subscribe button on whatever platform you happen to be using. For right now, thanks for joining us. We'll see you again in about 2 weeks.